Hello, everybody. Thank you for joining me again today. So today I have a very special guest all the way across the pond. I'm joined today by Nick Colas. So Nick is the co-founder of DataTrek Research. Now, DataTrek Research write an investment newsletter which is published daily. And frankly, it is one of the best things that I read in terms of their analysis and interpretation of what's going on in markets. And it's fantastic. And I'm really privileged that Nick is able to join me today on the program. Welcome, Nick.
Oh, thank you so much.
So Nick, before we kind of kick off into markets and everything inflationary and growthy and tech and all of that stuff, can you just give me a bit of a background, can you give the listeners, sorry, a bit of a background on you and really kind of what brings you to go through the somewhat pain of writing a daily investment newsletter and
Sure.
how uniquely qualified, frankly, you are for this.
Oh, sure thing. So I'm a born and raised New Yorker, Manhattan my entire life, aside from undergrad and grad school. I went to undergrad outside of Philadelphia, majored in archaeology of all things, and then went to business school at Chicago, University of Chicago, got my MBA there in 1991. And since then, I have been working in and around Wall Street in pretty much any job you can do. So for 9 years, I was the auto analyst at Credit Suisse, then First Boston, covering the US auto industry, which gave me a great perspective on the economy and basic financial modeling. And that was a wonderful experience. I spent 3 years after that working for Steve Cohen at SAC, the hedge fund. And there I really learned the nuts and bolts of how to invest and how to trade. I spent 3 years with Steve, which again was an awesome experience. Couldn't do what I do today without his knowledge and teaching. And then for the last 15, almost 17 years, I've been working in and around stock strategy and market strategy. First at a firm called Rockdale Securities based here in New York, and then for a large agency brokerage firm called Convergex that was spun off out of Bank of New York just before the financial crisis. And for the last 5 years, I've been operating DataTrek Research with my partner, Jessica Rabe, and we do a daily market newsletter. And, the reason for daily is, our clients have to be in the market every day, so we should be there with them every day. And I am fortunate enough to be able to write very quickly and effectively. And that combined with 30 plus years experience doing so many different jobs on Wall Street, I think gives me a real edge in helping our clients make money.
Yep. No, I can totally confirm that as I said, as a subscriber. And the analysis, it's fascinating actually, the differing analysis that both you and Jessica bring, because you clearly come at it from very different viewpoints. And I'm sure you won't mind me saying rather different, let's say maybe age groups as well, in terms
Yes.
of experience levels. But before we just go on, I just wanted to ask you, and I apologies, I'm going to spring this on you slightly. I mean, working for Steve Cohen, clearly, legend of Wall Street.
Yeah.
Two things I just want to ask that I was always, the Sunday morning phone-ins, where apparently Steve Cohen gets all his analysts online and basically gets them to call in every Sunday morning and pitch them their best ideas. That happen?
Yep. Yes, it
Yep.
does. Religiously, you had to do. They were usually Sunday afternoon, so anywhere from 1 to about 5 or 6 p.m.
Yep.
And he would spend 5 minutes just asking, okay, what's your best idea? What do you like? What don't you like? And he did that repeatedly with all of us every week, and also with a lot of the guys that he gave money to on the outside, so people who weren't sitting in the room with Steve, but had some of his capital as well. And from that, he formulated his viewpoint on the market for the week. What was the crowded trade? What was the uncrowded trade? Where were people positioned? And I think gave him a really interesting perspective, useful perspective on how to trade the week ahead.
Yep, fascinating. And the other quick question, was it true that SAC, the temperature was always that little bit colder in an SAC office to keep the traders kind of on edge a bit more and more awake?
There were three things about that room that were unique to any other trading room that I'd ever been in before. The first was that it was very quiet. Computers back then, you had to have a personal computer that was kind of like your mini server. All those were off the desk in another room, a refrigerated room. So there was none of that whirring of fans you used to get in old trading rooms. The second was CNBC was either off or muted. Everything was very quiet. And the third was, yes, it was usually about 66, 67 degrees. That's not uncommon, but certainly focused you on, on the task at hand, rather than, potentially getting sleepy over the course of the day. Not that it was all that easy to get sleepy, but yes, it was cold, quiet, and very focused.
Excellent. Thank you. Sorry for springing that on you, but it's just something which, as someone who's kind of grown up with the legend, you hear stories, and I just wanted to get it from the horse's mouth. So look, I appreciate your honesty there. Cool. So look, let's kick off. I mean, markets in kind of where we are as seen from kind of Wall Street today, because I mean, typically clients I work with, and frankly, most people outside a professional investment focus have a very much a long-term horizon. From a long-term horizon, we're dealing with high inflation that is coming down, but albeit very slowly. We're dealing with relatively high interest rates for the last, let's say, 10, 15 years, but not high in the longer scheme of things. And also, growth, which is just kind of muddling through a bit. Can you just kind of run through from your side of the pond, from a unique US perspective and a unique for your professional investor clients, what are your key concerns? What are you really worried about? And what are the main thoughts around markets today?
Yeah, you certainly touched on the really critical one, which is inflation, because it affects monetary policy and it affects the risk of recession. So the basic view from the US is that inflation is coming down, as you said, albeit slowly. The worry is the labor market is still extremely hot, both here in the US and in Europe as well. You've got either very low or record low levels of unemployment, which has been very sticky. I hear repeatedly, we have a lot of corporate customers as well, and we hear repeatedly from them that they don't want to fire people, even if the economy slows down, because it was so hard to hire them in the first place. And they want to retain them, which means they've got to pay them. So as a result, you're seeing very high wage inflation, 4 to 7% annually. And that is feeding into the into the overall price inflation that you see. It's not keeping up with it, but it is feeding it. And so the worry is the Federal Reserve has to raise rates to the point where they really cool that labor market, but it remains incredibly hot even right now. Not as hot as it was, say, at the beginning of 22, but still extremely warm. And that's creating persistent wage pressures and therefore inflation pressures. So the key concern is we still have to see higher rates. We have to see them for longer. And you get that persistent worry that you get this S-curve effect where a little bit more of a higher interest rate environment tips the economy over into recession. It hasn't happened yet, but that because of what happened last year, investors are very anchored in the risk of all of a sudden things falling apart. And so even if most investors are kind of acknowledging that the market's pretty good, there's still a fundamental concern that it's going to tip over again.
Yeah, and I'd kind of add to the UK perspective on that, where you have from UK typically rates are, albeit slightly lower, but we are going through this period at the moment where inflation is considerably higher and stuck. And I think certainly, I mean, we're recording this towards the end of June. Latest UK figure. The energy policy clearly of the UK was a massive contributor to the extra inflation early on. But what was really interesting now is that actually it shows the lag effect of inflation and how now energy impact is dissipating. However, the core inflation, which is the measure of inflation without energy, is actually just hit its highest level since 1992. And the Bank of England, again, is slightly freaking out, and it's hitting the front page of the papers.
Yeah, there's this unfortunate fact that goes back to the 80s, and everybody is aware of here, is that you need a recession to reduce inflation when it's this high. Yeah. You've never seen it come down quickly without one. Now, that's a real concern, obviously, for corporate earnings reasons, for macro reasons. Everybody understands that fact, and there is this hope that the economy is so strong here in the States, we can kind of glide through that uncomfortable fact and get us into a more normal inflation situation, but it's going to take years without a recession.
Yeah. And so you would say this for what your comments there, you would apply similar to both the UK and Europe?
Yes, absolutely. It is a uniform fact across every developed market that you need a recession to bring down inflation once it's as hot as it is today.
Yeah. Okay. And now, if we extend that further in terms of, and I want to keep a focus here on really kind of long-term focus on the stock market, and the sort of phrase that the market will always go up. You just need to give it enough time, and this sort of mentality around the long-term record of creating value. Can you just dig into a little more details in terms of, why really do you think that is? And why, when you look at those 100-year charts of equity versus bond versus cash versus gold, whatever, equity always comes out the top. What it is about it that you think that makes long-term equities such a sort of historically successful investment?
Yeah, it is. You're absolutely right. That's what the data shows, and it's very clear on this point. And the bottom line is that equities are a call option on human ingenuity and human creativity. They latch into, they're the only asset class that really directly connect to productivity growth, new ideas, innovation, and they constantly recirculate themselves. So, as probably many of your listeners have seen over the years, you have these lists of what were the top companies in 1970, 1980, 1990, 2000, and so forth, and they're always different. And that's the magic of markets. Capital flows to its best possible use, and the best possible use has the best growth potential, has the best return on capital potential, and has the best reinvestment potential. And that's a constantly changing and evolving process. All I can tell you about, we focus a lot in the US about how much Apple and Microsoft and Google and everybody else in big tech are a part of the S&P. It's like 27, 28%. I can guarantee you in 10 years' time, that list will be different.
Yep.
We'll know who's going to win, who's going to lose, but that list will be different because it always is. And equities give you that call option on whatever the new thing is. And that's why equities work. And if you break down by geographic region, they work better or worse in some countries and regions versus others based on that level of innovation and growth.
Yeah, really interesting. And I remember, with that 10-year chart, you're taking me back to when I was in Hong Kong for a brief time in 2006, and it was peak China opening, peak China, effectively building the most valuable companies in the world with China Mobile, China Construction Bank, resource plays, and then 10 years later, it's all big tech. Now, I think the really interesting thing now is that, let's say, the 10s to the 20s, if we just, which is a little unfair to actually just put a 0 on the end of the year and just say there's the 10-year focus, but certainly you can kind of go back and pick which were the 10-year winners, and really for our generation, and for our current investors, the last 10 years have really been all about big tech.
Yep.
The interesting thing is it's very hard to see out there at the moment of the next thing, because it's not obvious. And if it is obvious, it may be AI, but then big tech feels as though it controls that as well. So I think that's where I don't know, I'm interested in your thoughts on, you say it's going to be different. I completely agree, but it's kind of hard to see where else it could be.
Well, one thing could be, for example, NVIDIA, which just kind of recently cracked into legitimate big tech territory. Could a hardware company end up being the next big thing? Could it be the first company to $3 trillion? That's not a prediction, but it is a logical question, because they're building the tools that create the productivity growth in the rest of society and the rest of business. And so it might be that NVIDIA ends up being bigger than Apple or bigger than Microsoft because it's building tools. And then the next 10 years after that will be the services side of AI.
Yeah.
If AI is going to work, it's going to be a 20-year run. And perhaps the first run is the hardware side, and the next run is the services side. And maybe the services side will be a company that's right now being funded, going through a Series A in Silicon Valley right now.
Interesting. Yeah. And I think, can we just let's extend that for a little bit right now on the idea of locality and location of these countries, and location, of these companies within the countries. And can you comment why historically the US has been the bastion of creativity and entrepreneurship? Is it in terms of history? Is it in terms of the fact that it's an immigrant founder, entrepreneurial country? It was founded as an entrepreneurial country, it remains that. Or is it more because of local politics? And compare that to, say, Japan or Europe or the UK.
Larry Summers, our former Treasury Secretary, had this line a few months ago on Bloomberg, which I've never forgotten. And it is somewhat derogatory in typical Larry Summers fashion, but it is, I think, carries the spirit of something important. And he said, look, Europe's a museum, Japan's a nursing home, China's a jail. So what do you have left? It's America. And I thought, okay, that's fine, but what is America in that paradigm? And to me, America is a business. America might be a country and it has a government, obviously, but it is fundamentally a business. So that's one aspect of it. The second is we just have a big ecosystem of research laboratories, research universities. We have a very robust venture capital industry. We have, relatively speaking, fairly loose labor laws relative to Europe, for example, which allow kind of dynamic reallocation of labor. We have a reasonable rule of law. And those things combined with the fact that America is a business first and foremost have given America the edge. Who's to say if that continues? I personally think it will, because that's so ingrained in this culture. Certainly ingrained in the city where I'm sitting right now is New York. I mean, that's been New York since I've been here, almost 60 years. So that to me is sort of the essence of why America does something special and why US equities over time compound at far higher rates than Europe or China or Japan.
Yeah, I love that. So Europe museum, Japan nursing home, China jail. God knows what the UK is going to be. I would say it's a very anachronistic royal with a top hat on who actually doesn't do much and just kind of, floats through life. But anyway, maybe I'm a little bit biased for watching royals on Royal Ascot. Cool. Now that's really helpful. So if we going a bit further and then thinking about markets, and thinking about, we've got the key drivers of markets at the moment, and markets have frankly had a reasonable run so far in 2023 off what was a pretty rubbish 2022 and kind of back half of 2021. So again, that longer dated cycle, we had the big up during the pandemic, we've had the correction post 21, 22, and now we've kind of come back up a bit, not yet to the highs. There's a number of key issues and key factors that markets are looking at the moment. And I think certainly if we roll back to the start of 2022, the most fascinating kind of political change, I think, in our, most sort of surprising, shall we say, in our recent history was the complete 180 by China in terms of lockdown, lockdown, lockdown. Oh, look, we're reopening. And that literally happened within, it was a few days, it seemed as though they had just totally changed. That was a big potential boom, as in, wow, the Chinese economy is reopening. Yet it's kind of, and markets reacted positively in the short term, but it hasn't seemed to have followed through. And I'm just interested in your thoughts around, is that because it's slow? Is it just not happening? Is it because of government policies? Or, what's your read on China at the moment?
Yes. So, when we all heard sort of November, December that China was going to reopen and reopen aggressively, I think a lot of us harkened back to like 2010, 2011, when the Chinese really put the hammer down on stimulus post the financial crisis and really spurred that economy very quickly and very impressive. Remember, oil ripped and Chinese equities ripped. And I think we all looked at that and said, wow, that could happen again. The problem with that paradigm is that the Chinese economy is like 60% bigger now than it was in 2011, inflation adjusted. And so we didn't get that counter bounce because it was a smaller economy back then. They could push harder. They can't push as hard now. It's just a bigger economy. It takes so much more time to get back on the rails. We look at one kind of unique indicator on that front. That's Chinese air quality, which is freely available. Just Google Chinese air quality and you'll find the link. And we look at the air quality literally every week for the entire year so far, city by city for the top 10 cities. And we publish usually the top 5 in our newsletter every other Sunday. And it's been very clear that there were some cities that very quickly got back to full speed. Industrial cities in the center of the country, in the northeast of the country, they got back going very quickly. The big tech hubs, Shenzhen, didn't. Shanghai and Beijing kind of were stop and start. And it was very clear very early on that reopening was not going very quickly. Not so much because some cities weren't going, they were, is because there was no unified effort. And that country is now so big and has so many people that you need every top 10 city to be kind of hitting the accelerator in order to get the entire economy going. And that hasn't happened.
And do you think, I guess, clearly because the unique situation or unique structure of the Chinese economy is the fact that, it's a one-party state. There are no elections. If you complain, there are many issues. However, there is the flip side of that, is that the Chinese, to retain power, the Chinese government needs to keep people generally happy. And that was, in my view, that was one of the reasons why the lockdown 180 happened quite quickly, because they realized that you did see a couple of initial protests because the Chinese were able to look around the rest of the world and the rest of the world was free and they weren't. So, in terms of, and I remember back to the Chinese the Chinese boom in the sort of 06, 07, there were banners across the street, and you saw photos of banners across the street saying buy stocks, be happy, get rich, all of those things. Do you think that philosophy has changed from the government's perspective in terms of wanting to keep their workers and their compatriots happy and wealthy, or is that somewhat changed now?
There was a big problem in 2020 and 21 in China with a rapid increase in wealth inequality.
Yeah.
It existed before the pandemic, but the tech side made so much money so quickly. And tech in China is not like the US or Europe. There aren't 4 or 5 companies, there's like 40 companies. And they all went, all those businesses went to 1,000, on a scale of 1 to 10 very quickly when the pandemic hit, because they were mostly online and helped facilitate life. And so you had this huge rush of income inequality. And I think that is what the Chinese government worries about as much as should what does pandemic policy look like? So as much as reopening has definitely helped, the Chinese regulators, Chinese government is still focused on cutting down on corruption and focused on cutting down wealth inequality. And it's sort of, one of the features and bugs of capitalism or capitalist-like strategies is you create wealth inequality.
Yeah.
And so they're trying to strike a very fine line between, yes, getting the economy reopened, but not letting things go as crazy as they did in 20 and 21.
Interesting. Because it is that one sector, when you look at the global economy and you think, okay, again, the world generally gets smaller. It was you could argue that perhaps that's slightly slowed down in terms of the fluidity of goods and trades and travel and all of that stuff. The ease of globalization has, you could argue, somewhat reversed. I'm not going to say, but if it's reversed, it maybe just paused slightly. But when thinking about investing globally, you think, okay, well, you stick with if you just invest with let's say the S&P 500, you actually therefore have probably the best proxy for the global economy, because, Facebook, Google, Amazon, they're global companies. They're not US companies. China is the one unique situation with that, because big tech are not in China. They're not allowed in China. You do have some domestic, so you do have some US and global players clearly that are allowed in China. But as interesting as that, really, that technology, that technology sector is really kind of ostracized itself, hasn't it, from the rest of the world?
Yes, it's very true, and it's almost a parallel universe. For every Google here, there's a Baidu there.
Yeah.
For Uber and Uber Eats and other sort of delivery systems, you have Meituan and Pinduoduo, and there's almost a parallel universe kind of structure to it. The problem is that universe is only about 1 billion people versus 6 billion people in the rest of the world. So the addressable market for the Chinese companies is much smaller. We have a lot of tension here in the US about TikTok, which is obviously owned by a Chinese company. And that's sort of representative of the tension that you see everywhere, is how much are you going to let Chinese companies come into your market or a non-Chinese market for security concerns, because they have the same concerns about US companies. And so you have these two parallel tracks, and there's just ongoing debate in technology circles about whether or not those two worlds will split apart further or come together over time.
Yeah. Okay, interesting. And speaking of technology, let's remain sitting in the technology space, and we think about, frankly, one of the biggest catalysts. You mentioned NVIDIA before, but one of the biggest catalysts so far of 2023, which is AI. And I read there was an article in the Weekend FT a couple of weeks ago, and I've forgotten his name now, but it was the Lunch with the FT series, and it was an author, a sci-fi author, who described AI. He basically said AI, his theory was AI is totally mislabeled. The words artificial intelligence was effectively designed in, I'm making this up, the 1950s or something. And we think of robots, we think of Terminators. He said our modern version today we have of AI should be called applied statistics, because effectively it is a summary of using that mass engine of a computer, an enormous, powerful computer to really derive interesting information and synthesize interesting information from large bodies of data, and then spit that back to us in actually a rather readable form, but still following the sort of, call it the rules of the English language or whatever language you choose. Can you just, I found that really interesting. how do you feel about this as a groundbreaking technology? Is it all that's there? Are the scare stories accurate? What's your view on that?
Yeah, so you're right. Artificial intelligence is kind of a cheap term. I think it probably harkens back to Alan Turing and the Turing test, which was if you interface with a technology, can you tell if it's a technology or if it's human? And if you've used ChatGPT or Bard, those answers come back very fast and they feel very human. And you can ask it to do a wide variety of things. Like I'm personally a big Sherlock Holmes fan. So I asked ChatGPT to write me a Sherlock Holmes story. And it does a credible job in like 30 seconds. So that feels like a human interaction. So I think that's the way most people are kind of digesting this new technologies. It feels oddly human. You know, is it the next big thing? I mean, it obviously is. The question is, how do we use it? It's a very strange fact, but if you go back at look at the productivity data for the US economy, labor productivity, how many dollars of GDP per worker there are, you got a very brief burst of productivity growth at the beginning of the internet wave in 94, 95, 96, 97, and nothing since. There's an old joke that the technology revolution is apparent everywhere except for productivity data. And it's absolutely true. Productivity is still sliding in the US. It's been negative now for 3 quarters. Very worrying. So is generative AI going to give us a productivity boost? That is the critical question, because so far no technology has. Smartphones haven't, email, did originally, but hasn't since. And so where are we going to get that productivity boost? Because without that, Gen AI really is just an interesting asterisk or footnote to economic history. But if it can improve productivity, then it's very, very important. I think it will improve productivity, but probably not until the next recession, because we talked about recessions bringing down inflation. Recessions also do one other very important thing. They provide a step function increase in productivity because companies are forced to do more with less. So if they have that catalyst and then they apply generative AI, they have a shot at maintaining a higher level of productivity, but we're not there yet.
Interesting. So let's explore that a bit further, because the idea of, the UK, as soon as you started talking about weakening productivity, the UK is exactly the same. And there's a history of UK productivity just continues to sort of drip lower and lower and lower. And many a chancellor and many a government have been scratching their heads trying to work out A, why this keeps happening, and B, how to somewhat reverse this. And normally when politicians do that, they end up somehow manipulating the statistics to make it look as though it's gone back up, but in reality, it hasn't. And so, in terms of, if we just go back to let's go back for the technology revolution, so through late 90s, early 2000s, where really technology did jump. Is that because, why didn't productivity jump then? Is that because things just got cheaper and companies got lazier? Is that, and therefore, I don't know, what do you think?
Yeah, so 2 things. The first is there's a lot of controversy around this productivity data, as you know, and for a lot of your listeners know. I believe it's largely true because it shows up everywhere else in the system. Wage growth declined over, until the last couple of years, wage growth was in secular decline. GDP growth is in secular decline. You can just feel the productivity is not there. So it's a controversial topic, a controversial data set, but I do believe the data is true. As for why it doesn't help productivity, I've always had the theory that when a technology becomes quickly ubiquitous, it seems to not have the same effect on productivity as when it first comes out of the gate. So when it first comes out of the gate, the smart companies, the best companies, they use it aggressively. They get the productivity gains, and you see enough of a boost in national productivity out of those initial early adopters. Once everybody uses it, the advantage bleeds away. And so I think we're going to see the same thing with AI, at least we should in the next 24 months, because early adopters should get a boost, then everybody else will follow, and then the system kind of resets itself and you don't get further productivity gains thereafter.
Yeah. Okay. No, that's a good answer. And and thinking about AI and extending this on, it's a little bit linked to the top 10 discussion we had. And typically when you get, when you look at the top 10 performers, there is generally a theme of the top 10 performer. It might be banking, it might be global growth through oil, it might be technology. And I'm thinking around, frankly, if I think of like, who are the smartest people in the world and the smartest graduates in the world, I'm thinking kind of, and again, this is without picking names, but the one comes to mind is Stanford MBA. Harvard MBA, maybe not Harvard, who knows? But the idea of where do these guys and girls, more importantly, where do they get jobs and where's their graduate jobs? Because for years it was investment banks, and then it became management consulting firms, and then it became technology firms, and then for the last few years it's been crypto firms. And so, do you think now this is a rush that they go back into, or this goes into kind of big tech and AI? Is that where this ends up?
It sure feels like it. And I totally agree with your paradigm. That is one very good way to think about where marginal capital is flowing, because intelligence and aggressiveness, business aggressiveness are attributes, scarce attributes. So it does feel that way, but it's way too early to tell. Like I literally read an article 2 days ago from Crunchbase that said, okay, the tech AI bubble is over. Like it got too hot and now, VCs are backing away. I'm like, really? It's been 3 months.
We've just started. What else is going to make the market go up? Goodness.
Now the wrinkle is any AI startup is facing Google and Microsoft in this battle, and how they navigate that's going to be tough. But yeah, if you're a Stanford MBA and you get an offer from Google to work in the AI lab, you're probably going to go.
Yeah. And I mean, I guess you look at actually I should have extended that to MIT, which is probably more relevant for this sort of space. And what will be interesting then is not only looking at the kind of the graduates from those particular universities at level, but I wonder with the focus on those technical skills, do you then get a move away from the Harvards of the world, which was then, Harvard MBA into consulting firms, into banking firms? It does seem as though with the last two leaps of technology, we continue to move in a more technical, we continue to get more and more technical.
I have a personal theory about business schools in the US. And to my mind, there's 3 themes in business schools. Harvard's, which is all 3 answer one question. Harvard's question is, what is your goal? That is the right question for a general manager.
Yep.
Chicago, where I went to school, Chicago's question is, what is happening at the margin? Which is the right question to ask if you're a capital market professional. What is new? What is happening at the margin? That drives all prices. Prior information is in the stock, new information is not. And then the last one, Stanford, their key question is, what's new?
Interesting.
And that is how they teach their students. All 3 statements, what's new, what's your goal, what's happening at the margin, are all the most important question that you can, all important questions, but they're too complex to just have to combine them. So those 3 schools focus on one of those 3 questions. And you're right, Stanford has the edge right now because what's new is the most important question for society.
I think it's a fascinating world, and I mean, I guess with AI, from a consumer facing perspective, what have we experienced as consumers in terms of the AI revolution? And ChatGPT clearly or Bard are fascinating, and you can type in all sorts of things and you get all sorts of information back and you go, great. It's trying to work out, okay, that's fine, and that's kind of a novel thing, and you do it a few times and it's a bit of fun. But it's like, okay, how does that then translate to a business? And how does that relate to how do individual businesses use not specifically ChatGPT, but let's say the data analysis tools or something behind that, or the technology behind that? How do businesses and big businesses, even more important, small businesses, how do we as a small business actually use that to make ourselves more productive, more productivity?
Yeah, no, I think that the answer is a personal assistant. An automated Gen AI personal assistant, where literally from the minute you get up in the morning through your day is guiding you about how to maximize productivity by ranking the tasks that you have to perform, allocating time to them, providing gentle nudges to tell you when to stay on track.
Yep.
That to me would be the most useful for my day.
Interesting. Did you see Mark Andreessen just released an article about AI? I think it was last week.
Yep.
Yeah. So, I mean, I thought that was very interesting in terms of he'd talk about and for those who haven't read it, if you look up on, I think A16Z, on one of my, just Google Mark Andreessen's AI. And for those who don't know who Mark Andreessen is, he was the founder of Netscape Navigator, and now runs A16Z, or Anderson Horowitz, which is a very large, historically successful VC firm in the US. And his point was AI is not going to, his philosophy was AI was not going to be evil, and the Terminator mentality or Terminator vision that we all had, and some of the press has, is false, and AI will act as a personal mentor to every sort of step of society, which I thought was really interesting. And his philosophy was actually it will help the more disadvantaged. You don't need to be super brains. It's not going to help the super brains even more, but actually will help significantly more the lesser advantaged members of our society. Again, really interesting stuff.
I hope that's true. We'll see who builds the product. I mean, every disruptive product always starts with a low-end offering, and
Yep.
that would be the right low-end offering.
Yep. All right. So let's stick with A16Z, and we've touched on this before, and is their kind of investments and philosophy around crypto, because crypto clearly was when we think about where the smart Stanford MBA grads went, they were going to crypto, and maybe now they're not as many going to crypto. And I know you've done some work on looking at that talent. Crypto has its own very unique problems in terms of the regulatory, yet to be established regulatory framework. It was the Wild West for a while. Lots of people made lots of money and lots of people blew up, and the frauds and charlatans arrived and blew everything up. It's been going on since day one. How do you think about crypto now both as an investment case, but also, let's say, as a network and a technology in let's call it the Web3 world?
Yeah, so you're right. Andreessen Horowitz really, more than any other VC, kind of put money into Web3, put money into crypto, created their own DAOs, did a lot of work in the space. They recently started publishing what they call a State of Crypto report, which has a series of data sets behind it. You can Google it. It's a long analysis, but it does have several things that are quite useful in the micro. And one of them is how many developers are engaged in crypto projects, how many developers want to be in crypto, how many academics are writing papers about crypto. And by those basic measures of interest in the developer community, interest is down between 30 and 50% from the Jan 22 highs. So it tells you that with the blow up in prices, with this unwinding of the bubble, there's been a significant diminution in the amount of interest from the people who really matter, which is the developers and coders that will make the products that provide the next leg up for crypto. That's not to say that crypto can't go up or down or stay the same over the next 3 to 5 years. But if you think of crypto as a technology, it needs two things. It needs developers, and it needs them to build products people need to use. The biggest problem with Web3 has been, aside from NFTs, which were kind of a boom and bust thing, nothing really caught on as the next big thing. And if you don't have incremental interest from developers and business people in building those products, then crypto is not really going to go anywhere.
Yeah, you're right. It's that then technology can be exciting, and any sort of new boom at any point, any bubble, should we say, is created, especially investment bubbles, created on the promise of technology and the promise of use with the technology. I'm a firm believer in that. And you can look through history in terms of, the South Sea bubble was about issuing joint company stock for the first time. Tulip bubble was about the creation of exchanges and futures contracts and forwards and things like that. Crypto, again, the promise is there, which is decentralized money. And I get that. The use case today suffers a little bit. And I think, the idea of Bitcoin's use case, I think, as a decentralized source of wealth, and I kind of call it online gold. Yeah, I can see that as a use case. We've worked out already in the last 10 years or so. It's a crappy payment mechanism. It's, you choose Visa and MasterCard every single time over choosing Bitcoin to pay for anything. But as far as I think it's ubiquitous enough now that it's become effectively a noun as opposed to anything, and therefore potentially a sustainable source of value where you can cross borders with it. I get that. Ethereum, maybe. Everything else, I struggle. I struggle to see, what's the point? What am I, who's not necessarily, I'm not a techie at all, but what am I going to use that in the next 5 years? And that's what I want. I want to see that. I'm an optimist, but I just don't see it right now.
No, I think you captured the argument that I hear a lot from clients here in the States as well, which is Bitcoin, totally get it. Store of value, first crypto, never been hacked. That's a big thing. Crypto, the blockchain's never been hacked. And you can imagine how many people have tried.
Oh, yeah.
So a profoundly secure system at its core, not in the wallet space, but in the core space. The only technology you can say has never been hacked in the history of man, period.
Wow.
So great. Then Ethereum is the backbone for things where you might end up using a product that uses Ethereum, but it'll be transparent to you. So, online contracts, automated contracts. I can see that. That's definitely another interesting angle. Beyond that, it becomes hard to see like what's the purpose of the rest of these things. There's 10,000 of them. Like, who cares? Those are the two where the use case is very clear.
Yeah. And I think from reading and from other discussions, the idea of what the SEC, is doing in terms of the regulation, or trying to sort of introduce some regulation around this. And what's been really interesting is that, they've named, I think, I want to say it's somewhere between 8 and 12. I can't remember the exact number, but they've named a bunch of different of these tokens, which they say these things should be tradable, should be classified as tradable securities. And therefore these exchanges who list these things need to either delist them or put them, make sure, give the consumer the same protections consumers get in the market. I get that, because if there's no use case, that tail of 10,000, that's all they are. They just become tradable securities. And guess what? There's been regulation in place for tradable securities for over 100 years now, and for good reason.
Yep. I'll tell you, I met Gary Gensler with clients in 2015, 2016, down in Washington. And we had a day of meetings with politicians, senators. My former CEO is very politically connected, so he got us a great set of meetings. And we were all going fantastically well. Everybody was very chatty. Everybody wanted to talk to the clients. Clients were happy. And then we get to Gary, who was at the CFTC at the time, and he would not talk. It was one-word answers for half an hour. And I finally said, would you please help me provide some value to these customers who spent a lot of time and money to come here and see you? And he said, no. And that was sort of the end of the discussion. And for anybody who thinks he's going to change his mind about Bitcoin or crypto, he is not. He sees the world a very particular way, and he is not afraid to piss off a lot of people in pursuit of what he thinks is true.
How much, it's good. I mean, it's great insight. How much does the top end of politics impact on that sort of regulatory policy? Is that a factor, or is the SEC protected in the case of, let's say, the British Civil Service, which just has its own, is non-political, or is the SEC partly political, or how does it work?
I would put it this way. I think the SEC is partly political at an individual level. Okay. So if you're talking about a particular person or a particular firm, I think there can be some pressure brought to bear. If you're talking about an asset class, not so much. And that's where we find ourselves with crypto.
Okay. All right. Interesting. Cool. And I know you guys have just jumping further on, again, going back to the sort of markets, markets went through 2022. We peaked out of, call it early, literally year end 21 into 22. And, a lot of investors went through that volatility of 2022, and it felt like 2007, 2008 all over again. It's horrible. When you look across and you see US markets down 4%, it's, they're scary times. Can you just talk a bit more about those volatility and what volatility does to markets? And almost in a sense, we talk about, markets rise on a wall of worry, and as markets go up, as indices generally climb and stocks climb, volatility goes lower, but then they tend to fall off a cliff and volatility jumps. And I know you guys have done a lot of work on that. So can you just explain a bit more on kind of why that happens, and what, looking at the underlying mechanics of what drives that?
Yeah, no, it's a grimy topic. We write about it a lot because it is super important. So here's how volatility works. Let's say you have the S&P 500 and you have 11 sectors in the S&P, and you have obviously 500 companies. There's actually 504 or 5 stocks in the S&P because of Google and Google L, but there's 500 companies in the S&P. When things are bad, investors treat that as an asset class, and every stock goes up or down. Every sector goes up or down, because investors are saying, I don't know if there's a recession coming. And that's what happened in 2022. I don't know if the Fed's going to drive us off a cliff. I don't even know if the Fed can solve inflation. All of those questions were the big questions of 22. It started with, can the Fed fight inflation? That was the sell-off through June. And then it was, oh my God, we're going to have a recession. And those were the lows in October and December for the NASDAQ. And then that's why that market worked that way. Correlations were extremely high. Everything traded together. That's why you got down 4% days. The VIX, which is a very common measure of volatility, CBOE VIX index, hit a high of 36 last year. That's 2 standard deviations from the mean. And it was in the 20s and above 20 for almost the entire year. 20 is the long run average. And that's because correlations were so high. Investors were saying, God, I don't know what's going to happen here. And so just bought or sold stocks as a basket. This year has been entirely different. Correlations have declined because investors are thinking, okay, we're not going to have a recession. The Fed's almost close to done. The global economy may not be ripping, but it's in pretty good shape overall. It's not going to fall off a cliff. And so I can pick tech versus energy versus financials versus healthcare. And all those 4 groups have had very different returns this year, ranging from very good for tech to very bad with energy. So correlations have fallen apart. When correlations decline, volatility overall declines because different stocks are doing different things on different days and they kind of offset each other. So it's a kind of longer mathematical explanation to what actually creates volatility in markets. It's simply when investors are thinking, oh my God, we're going to have a recession and we don't know where corporate earnings are going to be, or things are okay. And I can make some bets here. I can get short some energy. I can get long some tech. And I feel comfortable doing that because I'm not going to get hit the next day by a 50 basis point rate increase when the market was expecting 25.
Yeah. And so I know, you've done some work, in terms of VIX spikes, and you said, I think, the high of the VIX last year was 36 or 37. I think you said it's 36. And so you think, okay, when VIX starts getting at 25, 30 plus, things are a bit scary out there. And I remember, I don't know if it's correct, but if I remember rightly, the VIX during the 2020 kind of COVID crash, it hit something like 80. Is that right?
Correct, 82.
I mean, which is enormous. Actually, well, what is that? So that's what, divide that by 16. How's my maths? 5, just 5.5, something like that.
Yep.
So that's effectively a 5.5%. It's pricing in a 5.5% daily move on the index, which is obscene. And so, right, when the VIX goes completely haywire, that actually with some sort of confidence, it's not going to stay at 36. It's definitely not going to stay at 82, and it's going to come down. And that potentially becomes interesting points as effectively call it a contrarian buy signal for traders, shall we say.
It is the most reliable buy signal out there.
Right.
The reason people ignore it is because it's very scary when things are at 36.
Yep.
36 was not only the beginning of the rollover for the economy in the US, but it was also the Russian invasion of Ukraine and oil prices spiking to 110 US. And so you look at that and say, wow, you want me to buy stocks when there's a land war in Europe for the first time since World War II, and oil prices are jacking and my interest rate picture is cloudy? Yep. No one wants to do it. But you're right. It is exactly the right time to buy.
Yeah. And I think what's really interesting is that argument in terms of the right time to buy doesn't hold necessarily as the right time to sell on the other end of the spectrum when the VIX is at 18, 15, 14, 13, down there, does it?
No, it does not. There's an old saying in the US, you never short a dull market. And when the VIX is running below 15, it is a dull market. I lived through that for years in 2015, 16, 17, and it's painful. I worked very closely with options traders during that time, and they had nothing to do for weeks at a time because volatility was so low, but the market was going up. So yeah, high VIX is okay. You got to look at buying. A low VIX is you probably got to stay long.
Interesting. Yeah. And so, for example, at the moment, we are seeing the VIX in a relatively low, I don't know what it is today, but it's 16, 15, 14, something around that sort of level. That just doesn't give you a strong indication on anything, I think is what you're trying to say.
I think the most you can say is that it is a dull market. We're going into summer. July is typically a good month for equities in the US, believe it or not. September, not so much, but we've had a very strong start to the year. And history says that is a pretty good setup. So the VIX is kind of where it should be for what we know about the world. And it says you probably got to stay long.
Yeah, interesting. And I think the last topic I just want to touch on is, we've talked about interesting, investment ideas and interesting technologies. And I guess one of the really, and although this is actually goes back to your specialist area, was one of the things of the sectors where we've seen the greatest technological change in the last 20 years is the auto industry, with, effectively many countries. I mean, I think the UK is one. The UK is talking about banning the sale of, well, it was talking about banning the sale of combustion engines by 2025. And I don't think that how feasible that actually is ever going to be, but the writing's on the wall in terms of, a fundamental shift of technology that is going through across a product that, frankly, I don't know the percentage, but virtually everyone has access to or somehow has. Can you talk about your thoughts around this huge shift and the struggle that the traditional automakers have, and the arrival of the Teslas and some of the Chinese names in terms of the electronification of the auto industry, and how does that impact?
Yes. So as I mentioned at the top, I spent 10 years doing nothing but analyzing the auto industry, first for Credit Suisse, and then another 2-3 years with Steve. So I think about this sector a lot. The most important thing to know about the global auto industry is there's too much capacity. There are too many car plants for the demand that the world has. That's been the case since the 1980s. The industry was a growth industry from the World War II through 1970, and the oil shock in 73 made the industry in the US and then in Europe largely mature. You had growth in emerging markets like China, and you still do to some degree, but by and large, there's too many car plants everywhere in the world. Car companies are favorites of governments. They hate to see car plants close because they employ a lot of people. So car plants, there's too many car plants. That's why it's very difficult to make money owning a car stock, GM, Ford, any of the Europeans, because demand is cyclical and because capacity is too high. Therefore, margins are too low and returns on capital are low. Nothing about that is going to change with EVs. Every car company on the planet right now knows one thing. They have to transition to EVs in the next 20 years, or they're not going to be in business. Because as you said, the regulatory writing's on the wall. So they are going to push very hard to recreate their current production base with EVs because they don't want to lose share. They can't lose share.
Yeah.
And so you're going to end up with a series of very long price wars in EVs, with probably some new winners like the Chinese companies and some losers like the marginal Japanese companies, maybe even some of the marginal US companies. But you will not solve the capacity problem, which means you will not solve the margin problem or the return on capital problem. The only reason any car company wants to make it to that bridge is because eventually we will get self-driving cars. And that changes the demand profile dramatically, because all of a sudden you don't need to own a car for yourself. You can do a rideshare situation with much more reliability. So bottom line is, it's a very difficult industry. It requires massive capital investment to make subpar returns. The best place to be in the car industry is as a buyer, because you're buying a very high quality product for a relatively low price compared to what it should cost. But as an industry, it's going to go through a lot of turmoil, but EVs will not solve any of the problems that the industry's faced the last 20 years.
Yeah, interesting. And they have to, you touched on there, the self-driving, clearly that incorporates a number of the other factors that we talked about, which, technology, the AI, all of that stuff, which they have to work out, with they being the car companies, the manufacturers have to work out how to incorporate that into their product at scale.
They do, and it is a whole lot easier to ask ChatGPT to write a novel than it is to get AI to drive you from, in New York City, from where I'm in Midtown to Wall Street. Like, I'm not sure I will see a self-driving car operating in Manhattan in my lifetime. Yeah, it's just too difficult to challenge. It's too concentrated, too dense.
Fascinating, excellent. Nick, look, I've really enjoyed this. Thank you. Before we go, I just want to ask you one question that I ask all my investment professionals, which is, if there is one piece of learning you have done over the past 20, 30, 40, I'm not going to, let's say 20 or 30 years in your investment lifetime, that is either completely contrary to what you learn in textbooks on, at undergrad and university days, or is totally mistook as one of these urban myths, what's one of those core fundamental things about investing that you've learned that actually either shouldn't happen or is taught the opposite should happen in textbooks?
Yeah, it is prospect theory, which is a Nobel Prize winning concept by Daniel Kahneman and Avis Tversky, who passed away before he could get the Nobel. And it says something very simple, but very profound. It says that human psychology overweights the effect of pain and underweights the effect of positive outcomes. And so we spend a lot of time worrying about the negative because it hurts so much more than an equivalent positive. That is totally contrary to classical economics, which says marginal utility is equal on both sides of the gain or loss. Losing $1 is the same as winning $1. That is not the way human nature works. Losing $1 is twice as painful as gaining $1 is pleasurable. And so it really is difficult as an investor to try to remember that your fears of loss can't over-inform your perspective on long-term returns, because the long-term returns will happen. But if you only focus on the fear of loss, you're overweighting psychologically the effect of those outcomes. I think Seneca said, we suffer more in imagination than in reality our entire lives. That is prospect theory. And so that's the most important thing I've learned. And it's a Nobel Prize winning concept, but it still doesn't get enough, I think, attention.
I want to just capture that last 2 minutes. I'm going to put that on and I play that to every single client that I meet to say, and this is, it's just that long-term, the number of times you get phone calls from clients, oh, I'm worried about this, I'm worried about that, I'm worried about this. Should we move to cash? Should we do this sort of thing? And it's just, I think part of what we do is is the education piece is really important. It's not just using allowances and tax reliefs and investment strategy. It's just working with clients around their education around exactly that, about that long-term investment strategy. And you just got to take time. So thank you so much for support. That wasn't pre-scripted, by the way. So thank you so much for supporting something that we have already talked about ad nauseum with our clients. Nick, look, that's fantastic. We're coming up to an hour, so I really, really appreciate your time. Do you want to just talk a bit more about DataTrek and what you do and how any listener can get access to it?
Sure. Very easy. Go to datatrekresearch.com. There's a box right there on the home screen. You can put your email address in, get a 2-week free trial, no credit card required, no personal information required. See if you like the work. And then it's very reasonably priced. It's $100 US on a monthly basis, but there are some specials that you'll get offers to as you go through the trial process. You get it for a little bit less.
Yeah, and I'll put a link in the notes on the on this podcast as well. Nick, thank you so much for your time. I really, really appreciate it. It's been fascinating discussing with you as always, and mate, look forward to catching up soon.
Very good. Thank you.